This ETF Minute is sponsored by Hamilton ETFs. This video is for general informational purposes only and not personalized investment advice. Are you looking for a simple, low-cost way to own some of Canada's strongest dividend growth stocks? Hamilton ETFs offers the Hamilton Champions Canadian Dividend Index ETF. The ticker on that is CMVP, and it's built to invest in high-quality blue-chip companies with a long track record of dividend growth. And right now, there's no management fee until January 31st, 2026, and only 19 basis points after that. CMVP, which tracks the Selective Canada Dividend Elite Champions Index, provides equal weight exposure to 25 blue-chip Canadian companies with an average market cap about $87 billion. Now, every company in the underlying index has a consistent track record of increasing the dividend with no decreases. And across the portfolio, the average annual dividend growth rate exceeds 10%. So what's inside? The portfolio tilts towards sectors that have long driven Canada's markets, about 35% financials, 19% materials, and 14% industrials. Inside are many of the names Canadians know well: RBC, CIBC, Loblaw, CN Rail, Enbridge, and Sun Life. And because the index is equally weighted, it helps to mitigate over-concentration in any one name. Now, when we backtest the underlying index using actual historical data, it's demonstrated a strong historical track record going all the way back to 2006. Over the long term, it's showed an annualized return of approximately 9.5%. This is compared to 8.1% for the TSX 60 over the same 19-year period that ended October 31st, 2025. And during that period, when markets sold off, the underlying index has shown resilience. For example, in 2008, when the market sold off, this index fell the same amount as the TSX 60, but it recovered a lot faster. It recovered in about 21 months compared to 56 months for the TSX 60. Now, for investors who want a bit more exposure to the same index, there's CWIN. It tracks the same Canadian dividend index and employs modest 25% leverage to provide additional exposure and enhanced growth potential. Now, hypothetical backtesting on that underlying index demonstrated that applying a little bit of leverage increased the annualized total returns above 11%. Now, of course, leverage increases risk and volatility. In the case of CWIN, the leverage is being applied to a diversified portfolio of blue-chip companies, and over the long term, the compounding effects of that leverage can really add up. If you want more information on CMVP and CWIN, visit hamiltonetfs.com or click the link in the show notes. And remember, always do your own research and invest according to your personal risk tolerance.